Good afternoon, everybody. My name is Rob Clayton. I'm the technical analyst for USG FX, and today I will be talking about intraday RSI trading. Now, this is more about trading from the shorter term, so therefore I'll be looking to trade in an hourly, 30 minutes, and 5 minutes. The time frame of this intraday RSI is been back tested on many currencies, and also I found that with this period, it's a little bit more versatile when it comes to trading than it is when you use the 14 period. So to begin with, I'd just like to make a note that any advice is of a general nature only, and that your personal circumstances have not been taken into consideration. Just a little introduction, first of all, of USG. We are the market's leading online brokerage firm for currencies and CFD trading. We also have a head office in Sydney. It is a global company, and we're located in Macquarie Street. We have on our MT4 platform 60 foreign exchange currency pairs. Along with that, we have contracts for difference, which is CFDs on equities, indices, and commodities like gold, silver, and oil, as well as US stocks, as in the Dow Jones, and also the Nasdaq, and also the S&P 500. Along with that, we have Bitcoin as well. We've been operating since 2006, and we are well trusted with ASIC, and we're a regulated broker, and our AFSL license number is 302792. I've already gone through the disclaimer, but just once again, I'd just like to point out that any advice is of a general nature only, and that your personal circumstances have not been taken into consideration. So trading the RSI for a day trade. So just a little bit about my background. So my name, as I mentioned, is Rob Clayton. I've been in this profession now for 29 years. Started off in the late 80s. I was with Westpac Banking Corp as the main technical analyst for the room. I used to give morning meetings for the FX division, and also for the interest rate division, giving intraday views and writing reports for the traders from day to day, and also write weekly outlooks as well. So today I would like to talk about the reason behind I like to use this time frame as a free period, and it's not the holy grail, but it has over times helped me out many times. I don't often use an indicator just on its own. I do like to marry them up with maybe the MACD or the ADX, along with also with the stochastic. So, but today I felt that just like to outline how the actual RSI oscillator works. The relative strength index, or the RSI, is a momentum oscillator that measures the speed and change of price movement. It's developed by J. Wells Wilder, and the RSI oscillates between 0 and 100. Similar to the stochastic, by that, it identifies overbought and oversold conditions in the market. Getting to know your market through an RSI indicator can let you pinpoint reversals and more accurately, and thereby let you position yourself accordingly. The RSI is considered overbought when above 70 and oversold when below 30. Alternative signals can be generated by looking for divergence, which is a powerful signal, failure swings, and centerline crossovers. But when you're using that's for the 14 period, say. But when you're using the free period, you're actually looking for over 95 and under 5, which we will come to a little bit later on in this presentation. So when the market is oversold, you see here that we get to a point. This is the 30 line, and this is the 70 line. So when the market gets oversold here, you can see clearly for a while here the market was trading in a very low band until it found a trough and then began to recover. And as you can see from that point is we broke back above 30 and then starts to climb, and there's the 50 midpoint. RSIs can be used just like a stochastic. Some of you may use that, but we can use it to pick potential tops and bottoms depending on whether the market is, as I mentioned, moving into the oversold territory or rallying into an overbought region. As I mentioned, divergence is a powerful signal, and I do look for it most often when I'm trading. It is one of the main signals that really has very strong dynamics when it comes to a sharp turnaround, when a point is that the price is going down and the indicator is going up. So what happens is that as you get in lower lows in price and a lower high in the signal, is the fact that that gives you bullish divergence, and it tells you that the market's preparing to shape up to a turnaround to either a dynamic rally or just a short-term correction. Divergence occurs when the pattern disagrees with the indicator to a price action at the same period. It can have significant implications when trading, and divergence is when the price is moving in an upward direction, as I mentioned, but the indicator is moving in the downward direction or vice versa at the same time. Divergence can be found in momentum indicators or oscillators only. Divergence assists the trader to identify and react appropriately to potential price change. Therefore, the trader must act, or should I say make a decision about the trade that they hold by either taking profit or moving stop loss or even preparing to enter a trade. Seeing bullish and bearish divergence increases profitability by alerting the trader to protect his or her position. So how to identify bullish divergence? After a long trend, price creates lower lows, but at the same time, indicator creates a higher low. Acting upon this pattern signal, we can identify an up or downward reversal, giving us entry opportunities for long or short positions. Following the gold pattern, we can first see bullish divergence after a prolonged downtrend, which soon leads the price to a sharp reversal to the uptrend. There's your downtrend. Now bullish divergence is slowly being created as the indicator slowly rises, as you can see here. So from the first point, when this indicator is going down here, the market troughed, and then when it made its next low, the actual indicator was higher, and then eventually, as you can see, it broke over the 30 point as it was oversold and snapped to the upside, broke through the mid-range area and continued on till it got to a point into the overbought, which was around this region here. Then the bearish divergence formed to the second pattern. First of all, as you can see, you have a high with the RSI when it reached 70, telling you that the market was overbought. And you can see this prolonged trend is now getting a little bit tired for gold. The market dropped back a little bit, but you can see the indicator still maintains towards or hugs at the 70 level. And then the next point is we made a new high. We do have two dojis in there, which is a sign of the market showing some hesitancy towards the move up. And also you can see here the RSI didn't confirm. the rise. And then after that, you can see that the price starts to decline, breaks through the midpoint 50, confirming the signal, and continues on. In this example, looking at the Great British Pound versus the US dollar, displays bullish divergence in 2 occasions. So from the chart, you can see that the pound was declining quite considerably in a daily time frame, and that we've broke through the 30, which was the oversold level, and also we got this decline that came through here. Straight away, you can see from this point is that we got a trough around about the 10th of October. The indicator starts to rise. It broke above 30, and as you can see here, the market did stab lower, but didn't confirm it. So it was pressuring these lows here, but the indicator was going up. And look what happened after that. It snapped to the upside and then rallied quite strong, a small pullback, and then continued the rally. So a good indication from that divergence. Now, in this point, you can see that the indicator was declining in December 16 to January 2017. And while the market declined, you can see that the indicator was not carrying on with the actual price, but instead remained above 30, still quite close to an oversold period. Before long, the market snaps and turns around very sharply, and then a dynamic bull trend actually starts from the rally until it got to a point around 126. The failure swing pattern is a type of reversal pattern that can be used either by buying or selling from the signal. In an uptrend, we see series of successful higher highs and higher lows, but there comes a point when the price falls to make a new high. So this is the decline, breaks through the 30 point of the oversold. A failure swing when the market bottoms, breaks back above the 30 level, pauses, then pulls back slightly, and then you get the dynamic move. So that's what you call a failed swing. So the market sells off, oversold, breaks back up, small pullback, and then rallies quite aggressively. You see these quite a lot. So that's called a failed swing to the downside. And then the failed swing to the top side is when the market's rallying, breaks through the 70 period point where it confirms it's overbought, pulls back, and then as you can see, a small pause, tries to recover, fails to take on the 70 level, and breaks lower. So again, you've got the uptrend, overbought, small pull, tries to recover, and then a sharp sell-off. That's what you call or see as a failed swing. In this example, we're looking at the pound again against the US dollar. So there's your level where the market breaks under 30. It troughs, and as you can see here, we do get a rise and then a slight pullback from here. And then from the pullback, we get a sharp move up. But then again, there is divergence in there as well. But nevertheless, you can still use this example. And then the market kicks in very aggressively to the upside. In the second example, clearly shows you again. So there's your point when the market reaches around the 70 overbought territory. Then the market pulls back, tries to recover, fails to take on the 70, and then kicks in and breaks lower. And there you have it as the price declines to the pound. And the market rallies. Also, a little bit of divergence in there too. Now, this is something that many of us tend to slip when we're trading, is that a centerline crossover can detect prevailing trend direction by its actual crossover when it hits through 50 on up or down. So the center line of the RSI is at 50, of course, when I mentioned, and the RSI is above the 50 center or the 50 line, then the trend is up. Inversely, when the RSI is below the center line, the 50, when the trend is down. Therefore, trend recurs when RSI crosses above or below. So it just reinforces the view. So if the market hits around the 30 level and starts to stage a retracement, then you'll find that when it breaks over 50, then it reaffirms the trend, and you can add to your position and accordingly trade to your risk management. If the RSI crosses the center line from below, then the trend has reversed to the uptrend from the downtrend, and inversely, when the RSI crossed the center line from above, then the trend has reversed to the downtrend. Let's have a look at that a little bit more closely. So before we begin, there's your 50 points, clearly identified. There's your 30 mark as oversold, and your 70 mark that is overbought. The first arrow breaks over the 50 cent line. This confirms a buy signal, and you can see that when we did get the break, before we even look where the trend was going, it was clearly in a bull candles all the way through. The second down arrow rejects the 50 center line, which reaffirms the rally. So you can see when we pull back, is it didn't take out and actually continued on. Now, when we get to this point here, is the fact that the market did get to a point of 70, telling you it was overbought, and you can see here the market was clearly struggling on this uptrend that went all the way through here, and then you got the doji indecisiveness, and then from that the market pulled back for 3 days, and then you eventually see that from the pullback that we got is that we got 2 dojis here. Now, when we got those 2 dojis, the market was sitting above the 50 line. Doesn't tell you to sell out. It actually paused, because the next move is from the indecisiveness of the sell-off is the candles actually start turning back into a bull case, and gold goes from 1,200 to 1,250 until it peaks here. But then overbought, and the market got here. Some divergence, one high from the 70, new high, 2 dojis, not confirmed. And then the market sells off. And from the third arrow, the decline actually breaks through the center line to reaffirm that we're getting a bit of a sell-off here. And you can see now that when we got close to this oversold period, once again, dojis come back into the market around 1,200. And then from there, we got a break of the 50, and it affirmed the dynamics through the actual strong rally in gold. And from the break, reestablishes the uptrend. So that's when you use a 14 period, and that's a longer term trade, or if you're carrying a position over the days into the week, and then into the week, and then into a month, you can see that the patterns clearly come through. So there's December, that was January, February of last year. Just a brief talk on the formula of the RSI. We don't need to go into it too much, because the USG MT4 works it out for you, so you don't really need to know the actual formula, but I should just briefly step into it and just give you a brief explanation. The RSI uses the closing price of trading periods to determine who dominates the market, whether it's the bulls or the bears. Assuming that the prices close higher in the bull markets and lower in the bear markets, therefore computes this as a ratio of the number of higher closes to the lower closes during a certain period of time. Most commonly used is, of course, the 14-day period or the 14 period. So the formula works is RSI, the formula minus the RSI equals 100, so it equals 100 minus 100 divided by 1 by the RS. Seems simple enough. Yes? No? But the RS needs to be calculated first. The RS equals 14 days of an exponential moving average of the up-day closing gains. Divide that by the 14-day exponential average of the down days closing losses. The exponential moving average stands, of course, and is used to smooth out an average of serious values. This is done by taking the latest 100 days trading days, assessing which ones were up days and which one were down days, and then calculate the moving average using 14 days as a parameter. Apply the RS in the first RSI formula will give you a value between 0 to 100. The real test with the relative strength index is to know what boundaries apply for when a market is overbought and oversold. This usually comes to you after having studied a market thoroughly, and I do stress that. So when trading, always backtest any market, whether it's going to be, for instance, gold or silver or oil, if that's your preference in trading, or if you like to trade the majors, then look at some back testing there to see how well this time frame actually works. Sometimes you find, well, say for instance the S&P 500, well, the 14-day hasn't worked very well now for over 2 years. It's been maintained in an overbought condition for a very long time. So obviously this indicator on its own would not be reliable. Common rules for the RSI are beneath 20, of course, for oversold, and above 80 for overbought, but that is just a rule, and it inevitably will vary, as I mentioned, between each individual market you trade, as I quoted just then about the S&P 500. The Australian dollar going back nearly for 8 months. So first of all, we've got 2 points. So when the market was getting towards the 77-cent region, it was getting close to overbought. And then you see a rejection from the 2 attempts, or at least 4 attempts, my apologies. And the market declined back to 75 and then got to the midway point and just briefly shot under there. And you did get a sharp sell-off for 1 cent. Then the market troughed. Now you would be waiting for the next signal, which was here. And you can see the market did shoot up on that last 2 days. And it got a little bit close, but then didn't sustain, topped out again as it got near the 70, and the market sold off again. And through the 50, did continue to sell off. And then when the market bottomed out, you can see that when it finally broke the 50 line here, it continued on the rally, very strong. Then we have divergence, clearly. So you got the price going up 1, price going there 2, and this point here, divergence. And look what happens after the divergence was confirmed. Even if you missed those 2 days, you get on the next few days, you still would have got the tail of that sell-off quite easily. So there you have. So do, when you're trading, look for these signals. They are very dynamic. And as I said at the very beginning of this presentation, divergence is a very powerful signal. And of course, you can see here, look what the Aussie did. It went from 78 cents and confirmed all the way back down to 73.5 cents. very good confirmation when trading. Then we got oversold. At this point here, came in line with the RSI. Oversold again. And as you can see, that from the recovery from the oversold, it got to 75 cents. Didn't break the midpoint. Stayed underneath the 50 line. So it didn't get you longer. It was giving you a little warning sign. And if you saw that rejection from there, you may have sold out your position somewhere here. You still would have got the tail of the downward move until we got to this trough. And if you notice inside here, as we had 4 attempts, the RSI wasn't going any lower. It was oversold and also some divergence to the bullish case. And as you can see, when the market starts to rally and when it broke through the 50, it carried on all the way up to 77 cents again. So then around 75 cents, the market did get caught long. And you can see here, there is a little bit of divergence coming through here. Fails to break above 70 as the market goes higher. So a bit of bearish divergence coming into the market. And then we start to get a bit of a turn. And then the market shows you the divergence and then starts to take the tumble. Until we got to oversold point here. Not quite under 30, but did give you some warning signs that we were getting low as we approach the 75 cent mark. Now, trading with the period of 3, which is what I've been waiting to talk about. So getting past the first part, we're trading from the 14 period, which is the very common and most traders tend to use. This is a period I like to use. And as you can see from this demonstration, how intraday it can be used as quite a powerful tool. As I mentioned, it's not the holy grail, but it does give you some good responses when it's rather to exit the trade, enter the trade, when the trade is getting to a point that you should take profit or place your levels in accordance to your risk management of stop losses. For the intraday, when you're trading long, using the 3 period, is whether that's going to be an hourly, 4 hourly, 30 minutes, 15 minutes, is the fact that when the period falls below the 5, which is when it's oversold, and you can see that the price breaks eventually will take a swing and reverse from there. That formed just before the RSI and confirmation of the bull trend. The 3 period drops below 5 briefly again, and then a buy on the break of the upside as the bull chart candlestick comes through. And vice versa, when you're trading from a 3 on an RSI, when to go short is that when the market is trading over the 95, it's either to sell out your long positions or it's telling you that the market's come to a point that there's going to be a reversal. So if you're holding long, you should actually either be going short or taking profit. Once again, prices break below the lower of the swing, and that's formed just before the RSI signals, and the confirmation of a bear trend is actually starting to come through. And then from the rejection around 95 to 100, again from the access, the buy break of the low of the bear candle, so you're getting out. To sum up, we look for 2 RSI signals, the first one to show us the trend and the next one to show us the trade. Here's a good example of gold just recently. Now I'm using the 1 hour intraday trading. So as you can see here, first of all, let me just outline, is at 95 on the axis and 5, and we're using 3. All confirmed. You can put these lines in on your MT4 to give you a bit of an indication. So you can see that and the midpoint is there. So let's have a look, see how it plays out. on an intraday outlook. So the market topped out around 1,350. We had about 4 attempts in the hourly time frame, but you can see here the market from being long, if you was trading around say 1,340, here's the market went up $15 and got to a point that's warning you that it was getting overbought and also to get out. So it touched it, turned around, went through the midpoint, little sharp indicator up, but still carried on. So first of all, you'd either short the market, got out your longs, or prepare for your next trade, which would have been short. Then, after the market did sell off quite aggressively, as you can see, so it sold down from 1,350 down towards 1,330, or 28 to be more precise. As you can see here, that the market fell $20 and quite a sharp fall until it started to trough. Gave you a warning signal as it fell under, and then the buy signal come through from the 5, which I explained a moment ago. So you're either getting out of your position to go long or to square up. Now, through the course of the day, or if it's in the night, depending what time you're trading here, here's the fact that it was in a steady uptrend and then got to a little bit near overbought, and it did drop away slightly and then fell through the midpoint, but got to 30 and it's finding a bit of a base here, giving you an idea that the market's not fully breaking down until it got to this point here. And look what happens afterwards. So we got the 2 points at 95. There's your cap. Bearish divergence. 1 point and then the second point. No confirmation from the RSI. A great indication here to get short somewhere around 142 to 146. Quite easy would have got short after the occasion. As you can see here on this last point, on this last peak, you still had ample time. Now this is an hourly chart. So you got 2, 4, 6, 8 hours of trading to the bear case. Your stop loss would have been above that candle maybe, or maybe above 49, depending on your risk management. But nevertheless, if it was above 46 where you got in, about 43, you never got took out. And look what happened after that, is the prices plummeted from 46. A $40 drop. And then you can see the market again giving you a bit of indication here. What can you see? Divergence. There's 1 point, there's a second point, there's 1 point, there's a second point. So there's the first point. The market hit around about 1,326. First warning sign to start thinking about getting out of your position, being short. There's the second confirmation on that last stab down. Even if you didn't trade that position because it was too fast, you still got around 124 and onwards because the market clearly rejected that region. Okay, now moving on from those 2 examples that I showed you. So from the full, if you're a slightly longer term trader and you would like to use a 14 period, just remember that when you're trading in a shorter time frame of between say 5 to 15 minutes, I recommend to go to the 3. But when you're going to go into 14, you would have to use that for maybe the 4 hour to the daily, weekly, or monthly. Moving on to our services and platform, USG is an ASIC regulated and award-winning Australian forex broker. So you're probably asking yourself, why would I choose USG FX? Well, we are also premium access to Trading Central's award-winning technical analysis, free trading signals, alerts, and news events delivered straight to your MT4 platform, whether that's going to be on your PC, on your iPad, or on your iPhone or Android. Free lifetime membership to exclusive Traders Club support center. Access to our trading psychology evaluation software, which is Swicotation. Free access to our intraday market reports. Live analysis of the markets every day. One-on-one mentoring with myself, Rob Clayton, ex-Westpac technical analyst. So where I be talking to you and finding out your ideas of trading, and also how you actually like to look into the market in terms of whether you're a longer term, shorter term. And it's all about tweaking your trading style. So the one-on-one mentoring is actually quite useful. It's a great tool, because I find it's a lot of people in my past experience have missed certain elements. And when you just put those couple of pieces into the puzzle, then you walk away and it all seems to just fall into place. Along with that, 10% welcome bonus is on the first deposit, which we can go into in a moment. You have withdrawal approvals within 24 hours. Segregated client funds are at the Commonwealth Bank. We don't hold any funds whatsoever. They're all located at the Commonwealth Bank. Along with that, you have your very own dedicated account manager. So if you have any problems, you'll be able to speak to someone who's dedicated to you to look into what your query is. And also we have negative balance protection. So what that means is if you've got a position on, and just say, for instance, if the currency or the whatever asset you're trading is, if it falls into negative balance, is that you're not liable. So if you've got a stop loss, or if you've got a position on and the market rallies or collapses in a point where your position, say it gaps 50 points, and then you're at a loss, you're protected against that, because we will take the loss, not yourself. Also, we have 24-hour client support by a professional and our friendly staff. Our trading platforms are the MT4 and the MT5. We've got a risk management, and also we have Zulu Trade and My FX Book for social trading. Along with that, we've got the MetaTrader Mobile, which is for the iPhone and Android. And also we have the Web Trader. Along with that, we have the multi-terminal trader also. From the Trading Central Services, we have the daily technical reviews, which is from myself, where I send out an intraday report every morning, talking about six assets, being four currencies, which will be the Aussie, the Euro, the dollar yen, and the British pound against the US dollar. And then also I talk about the gold and also the West Texas Intermediate crude. Along with that, I also produce a webinar for about 4 minutes just to talk about the markets. If some of you haven't got time to read, you can just click on the link and then just listen to the presentation while you're traveling into work. Along with that, we've got the trading signal straight to MT4 platform. We also have online technical research, and also for those that like to also listen to your YouTube, or is that we have the Forex TV. We have the Recognia trading system. Now, this is the newest high-tech innovation in FX trading. We hold it, and at the moment, you'll see that with USGFX is one of the very few brokers in Australia to offer this state-of-the-art trading system to our clients. Get the ultimate edge in trading via live intraday trading signals tailored to your preference so you can choose smarter entry and exit points. And then we have the ongoing VIP access to the full suite of the Traders Club program, which has the products and services. This is hosted and presented by myself. So, as I mentioned before, you can be prepared for the up and coming week. So on Monday, I talk about the market ahead. So I perform a 1 hour live webinar, which is interactive. You can join me at 7 p.m. on Monday and ask questions about markets, about your positions. If you're unsure if your position is right or wrong, we can talk about that. And also I'll talk about the economic calendar for the week, the risk events coming in, and also pointing out that if you're trading certain levels, where the big levels are. And so that's on a Monday. And then also we have the Traders Club Masterclass, which is on a Thursday, which is another live webinar for an hour, where I'll be talking about, like today with the RSI, I talk about indicators and how to use them to your best advantages. And then, of course, I have an intraday FX report that talks about, as I mentioned, intraday trading. It talks about intraday levels, direction, and my bias and the view for the day or the coming week. As I also mentioned at the daily video, if you haven't got time, where you just click onto the link and you can listen to my views. You can also get special access to powerful and smart trading signals, alerts, and also delivered straight to your platform as well. Now, for this webinar promotion, we're offering for a $5,000 deposit, which is where you'll get my weekly live market analysis report. You get the weekly Traders Masterclass, and also you'll get the intraday report and video. Along with that, we offer you the Trading Central services, which is the trading signals straight to your MT platform, which is two award-winning technical analysis reports daily, FX TV as well. And as I mentioned, if you do deposit $5,000, you would obtain a $500 deposit bonus. This only is for the webinar attendees for today, so please act as soon as you can if you are interested in this promotion. Okay, if there is any questions, I'll be more than happy to answer any of your questions. Okay, as there's no questions today, thank you very much for joining me to this webinar. As always, I do these webinars from fortnight to fortnight, and they are very useful to your trading, because I find each day, even like myself, you learn more and more upon the actual trades that you actually look for, and sometimes you miss. It's always good that from my point is I can point out quite a lot. Sometimes as a person who's beginning into this new adventure may like to obtain more information. So if you feel that that's your where you would like to go, then please act very soon and contact us on our website and find out more about our promotions, our services, a little bit more in detail by one of our friendly staff. So again, thank you very much for joining me today, and I wish you all a very excellent week ahead.